Let's look under the hood for Bitcoin and Ethereum, and let's look at on-chain data. So these charts are taken from the Glassnode Insights newsletter. The link is in the video description, and it looks at the transaction data. So we are not just looking at prices, we're trying to understand what's actually driving those prices. And we start off with the number of active addresses for Bitcoin, or a 7-day exponential moving average of that. So we are averaging out these active addresses, but still we see quite a bit of volatility here, right? This is squiggling down, up and down quite a bit. And so the author of this chart also added a few comments here. I think this is a bit of an overinterpretation, but still what's interesting here is that since the Corona crash in 2020, the price increased and so did the number of active addresses, right? So the attention on Bitcoin grew. That then peaked in January of 2021, where the price was at roughly 30K. The number of active addresses stayed elevated. The price rose above 60K. Then we got our summer depression and then our recovery in the price all the way to a new all-time high of 69K. Now, what's interesting around this is that the number of active addresses did not reach an all-time high, right? See how the activity actually went down, whereas the price hit an all-time high, it went up. And if we take some other data in conjunction with this, I don't have this in this video, but in others on this channel, we see that this rally here was mainly driven by institutional buying. So by very large wallets buying. So we saw not necessarily more activity in terms of the masses buying, but a few very heavyweights, they pushed up the price. Now we do see the exact opposite happening now. So when Bitcoin is going down, the number of addresses isn't really moving that much. It's kind of like going sideways. And that's because now those large wallets, they are selling off, and the number of wallets that are only 1 Bitcoin or so, they are shooting up. So retail is buying up this dip, and institutional money created this extra rally, and now it's creating this extra depression here. Now, instead of looking at the number of active addresses, we can zoom out and we can look at the number of transactions per second. So this looks now at the activity in terms of shuffling Bitcoin around. When this is very high, then attention on crypto is very high. This is the 2017 rally, right, with the 2018 crypto winter. We can see during the winter when the price really collapsed from 20K to 3.5K, that the activity also went down. And this is pretty typical. In a bear market, nobody is watching crypto. In a bull market, everybody gets excited, new people on board. We can also see this in social metrics, as in, for example, the subscriber growth of YouTube channels or of Twitter accounts. When prices rise, everybody comes on board. When prices fall, nobody is watching. And so that's then when we want to buy, right? But this is by no means a perfect measure here, right? Because if you even pick the bottom for the number of transactions, right? This was the historical bottom. The price did not yet bottom. The price here was at around 8 or 9K at the transaction activity bottom. It then still fell all the way to 3.5K. So even though more people dollar cost averaged, even though more activity happened during this time after the depression, the price still went down further. So it was again the large players that sold here. People say that this final capitulation to 3.5K from those 7K, it happened apparently because of miner selling. So mining companies went bankrupt, they had to cover their losses, and that's then what created this excess supply and thus the price decline. Still, I think it's a relatively nice gauge to see, at least for the heightened values, if we are currently in a bubble. We also had, similar to the number of active wallets, a peak here at the beginning of 2021. And that's then when the price for Bitcoin was only trading in a sideways range, right? From those 30K where we had the peak, we then went up by another 30K. We also went down to 20K. So that's then when we moved sideways. Currently, we're still relatively low in activity. So again, a time to dollar cost average. It does not necessarily mean though that we have already seen the absolute bottom, right? Nobody can tell the exact bottom, but at least we can say that historically we are not at high levels. So this is definitely not a time to sell. If anything, it's a time to buy. Now, I like this chart quite a bit. This shows the total transaction fees measured in Bitcoin, not in US dollars. We can see how this really spiked up a lot during the 2017 rally, right? The Bitcoin network was pretty much congested. Single transaction cost a lot of money. And then with the crypto winter, all of that activity went down. Now, what's very nice around this chart is we can see how Bitcoin became more scalable over time. Due to the Lightning Network and also due to the adoption of some centralized exchanges, we can see the recent peak, right? The activity peak in Q1 of 2022. It was way, way lower than that peak in 2017. Again, we want to be dollar cost averaging in when the fees are low, when there's not a lot of activity happening, and we want to be dollar cost averaging out when fees are comparatively high. But fees tend to not be as high anymore as they used to. And that's because, let's skip this chart for now. That's because of this chart, the Lightning Network capacity. So we can see over the years, this is gradually increasing. So even though Bitcoin grows that massively year over year with, of course, a lot of volatility, even though we see all of that growth in adoption, the efficiency grows quickly enough so that the transaction fees don't spike as much as they used to during hype times. Now this here is the spend output profit ratio. So these are basically realized profits or realized gains. So if somebody closed a position based on the blockchain data, how much money have they won or lost? Again, a 7-day moving average. And we can see, of course, during the Corona crash, this went down pretty massively. And when there is hype times, and it's a good time to sell, this is relatively high. So again, you want to be buying when other people are selling at losses, and you want to be selling when other people are selling at wins. So you want to be somewhat against the general masses. So you would have bought in this region. You would also now buy at the current region and wait, of course, for the price to recover, maybe to 40 or 50K until this turns around again, and profits can be locked in. Now, before we go to the Ethereum-based on-chain charts, if you so far enjoy this video, please give this a like. It will help the channel grow. Thank you. So let's continue with Ethereum. Again, we've got quite a few charts over here, slightly different. We're starting off again with the number of transactions. In the same fashion, we can see activity growth during price growth and activity decline during price decline. There is a correlation. It's not a perfect correlation, but it's still noteworthy, so it does make sense to look at peaks and troughs over here. The median transaction gas price measured in GWei comes in waves, and this is usually due to gas-heavy applications. So in 2020, this was mainly DeFi. In 2021, this was mainly NFTs. Still up to this date, Ethereum's main gas consumption comes from OpenSea, from NFT trading. Even though NFT trading went down quite heavily, it's still one of the main use cases. But because NFT activity went down, the transaction gas price, or the median transaction gas price, is now very low as well. Connected with the gas price is also the burn, right? So since EIP 1559, Ethereum gets burned, and during very active times, Ethereum is even deflationary, as in the inflation that goes to the miners is lower than the deflationary pressure coming from the usage. This would then imply that Ethereum grows over time simply because when there's less supply going around, prices tend to rise if demand stays stable. Here's the equivalent to the Bitcoin chart, the spend output profit ratio. So how are people taking gains and losses? This is more volatile because Ethereum is being traded more. They're coming out of a depression and people are taking profits again. So we can see the holding period for Bitcoin investors tends to be longer. That's probably also the reason why it's less volatile. Ethereum goes up more in price, it also goes down more in price. There's simply more speculation happening with ETH, also because of the ETH merge. So there's no constant narrative, but always new news popping up that might require rebalancing the portfolio. We've also got the average gas used per block. This is declining. Of course, again, because of the NFT activity decline. So when the transactions themselves become less complex and people just swap or send ETH and they don't use it for NFTs, then the gas, of course, goes down as well. If you're not yet part of the Bitcoin Strategy Telegram group, feel free to join us. Simply search for Bitcoin Strategy channel within the Telegram app. We've got a similar analysis, just focusing on Bitcoin of last week. It looks at the macro cycle in more detail. Hope to see you in that video, and thanks for watching this one. Bye-bye.